So the dollar was that strong, and you really have to go back to 1985 to find a dollar that strong. And what happened in 1985? James Baker convened the Plaza Accord.
So I'm so glad you went there. So I interviewed a guy named Nicholas Eberstadt last month, who has been ringing this warning bell about that cohort that you're talking about, that kind of like 8 to 10 million have sort of lost people a prime working age. And he says he calls it a silent epidemic, but he says it's just toxic to culture and the productivity of a nation. Sounds like you feel the same way.
Not only, but I read Nick Eberstadt's research, and he's quoted in my book, Sold Out. So he was one of the sources I used in offering my own explanation about inflation, deflation, and the impact of the supply chain. So yeah, he's great.
All right. And Jim, when you were talking, I put up a chart there showing that real wages, I think, have declined for the past 21 months, straight, unbroken string here. So really important. So kind of the punchline of all this is people should gird for a rough year ahead, right? That's really kind of trying to suss out, just is that something people need to do? What I'm hearing you say pretty clearly is, the average person should pretty much assume the crass position, because there could be a threat to your income from, if you work for an employer, could be a threat to your portfolio. And we haven't really talked much about it yet, but if you're a homeowner, there's a threat to your home price, which for many people is the biggest asset they own. Correct,
but do it now. Don't wait till don't wait till the Fed figures this out, because they will be the last to know. I mean, look, seriously, Adam, by May or June, I expect everyone will be preparing for what we're talking about now. But my point is that the predictive analytic inputs would lead you to that conclusion today. Actually, would have led you to that conclusion last fall. But absolutely prepare now, because when it hits, it'll be too late. And stocks are down 30%. Like, I think I'll sell. Oh no, why don't you sell now? So, could talk about this all day with the Jim, but I gotta move on. So I've had a number of questions from folks for you about, and I know you've done a lot of work, writing about this with your newsletter recently. But what do you see ahead? I'm gonna cram several topics into one, but they're all related to money. What do you see as the outlook for the dollar this year? Folks are super interested in what you think about CBDCs, and I know you've done some recent reading on that. So what do you see ahead when it actually comes to the future of money? 2021, most of 2022, it got to levels maybe technically not higher than 2000. I was on vacation with the family and friends, and we were in the French Alps in 2000, and the euro was 80 cents. And we go out with the two families. We couldn't spend $100 if we tried. We ordered wine, 4-course dinner. You couldn't spend $100. It was wonderful. But then, the euro bounced back, got up to $1.60 in the kind of early 2000s. But so the dollar was that strong, and you really have to go back to 1985 to find a dollar that strong. And what happened in 1985? James Baker convened the Plaza Accord. It was basically, it wasn't the G7 strictly, but 5 major economies, Japan, Germany, a few others, to weaken the dollar intentionally. The dollar was just way too strong, and they did. And then the Louvre Accord in 1987 was like, okay, we did it, now let's stabilize. But that whole period of the 80s, mid 80s, 85 in particular, that's the last time the dollar was this strong. Now, dollars come off a little bit, kind of starting in October. You look at the Bloomberg Index, the Wall Street Journal has DXY, the Fed has their own index. This is one I use, broad trade weighted. But I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, and then another question is, apart from the fact that it's reliable warning of recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is inverted? It's sending a very bad signal. We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There's a serious dollar shortage, and people roll their eyes. They're like, wait a second, China's dumping treasuries, country Brazil's dumping treasuries. People hate the dollar. China's talking to Saudi Arabia about paying for oil and yuan. What do you mean there's a dollar shortage? Well, there is because, and we can see it, but there's a reason for it. I'm acquainting people with what I call the Q word, which is quadrillion. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, FX forwards, the whole thing, but they're all off-balance sheet. So they don't show up in, conventional ratios. You got to read the footnotes and they don't tell you that much. That's an awful lot of swaps and derivatives. What supports that? How do you get a $1 quadrillion position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay. So in a credit crunch, you're going into recession, which is where we are. What do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this, and I was general counsel and chief credit officer, one of the biggest government securities dealers for 10 years. And I know, you walk around the floor and, the guys on the repo desk or whatever, they're bargaining with their counterparties every morning. They're insisting on treasury bills. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, doesn't print dollars. Right. So where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars so you can pay for them.
Remember, the journey to financial freedom begins with a single step, and that step starts now. Hit subscribe, prepare your questions, and get ready to take control of your financial future with Geo Global View. I'll see you in the next video. Let's make those financial dreams a reality. Take care and stay financially empowered.